Everybody, welcome to the finance portion of the due diligence bootcamp. It's going to be led tonight by Miguel Vazquez. Miguel has been an angel investor with us for 3 seasons, I think. Is that right, Miguel?
Two.
Or
This
is,
will be
is
my
it
third
only
one.
2?
Yeah.
Yeah. Okay. And he's also been a mentor for us for other topics as well. So, Miguel, I'm going to let you take over and give us your professional background.
Okay. Let me share my screen. And share. And can you see my screen and my audio okay?
Yep, looking good.
Okay, perfect. So welcome everybody. So this is due diligence for first-time founders. If you're not a first-time founder, don't feel bad. But I kind of wrote it that way so that we made it very, very simple. And I kind of also titled How to Impress an Angel by Answering Investor Questions with Confidence. So if I had theme music, we would do it now. Well, we don't, unfortunately. So I'll have to just go to the next slide. Who am I? Why should you listen to me at all? That's up to you to decide. But my my career experience was in capital markets and wealth management. So job titles, I've been a trader, analyst, structurer, salesperson, financial advisor, and portfolio manager. Currently, I'm a venture fellow, a strategic partner covering Nevada for a venture firm called VU Venture Partners. And I'm an investor and volunteer for Startup NV and related entities and funds. So why does due diligence matter? So investors look at due diligence, and what they look to do is to validate the team, the structure, and the numbers of a startup. That process builds trust through transparency and helps founders stand out. So why would you want to stand out as a founder? Being, working with a VC firm for the last year and working with AngelNV for the last couple of years, you see a lot of what was called deal flow. A lot of companies come in to pitch. The average VC firm probably sees about 2,000 companies a year. So then there's a process to kind of, humanly possible to kind of go through all that. You need to weed things out. And you look for red flags. And one of them that could actually be kind of similar to like a resume is if it's disorganized. If information is inaccurate, if it's misplaced, if it's difficult to find, that could also put you at the bottom of the pile, which you don't want to happen. So if you're organized, then you put you at the top of the pile, and then you get the kind of focus that you want from investors. So how do you do that? This is what angels want to see. I think, kind of like a nice summary. So what we would like is founders that are capable and coachable. And with a background that is easy to explain. So for instance, for example, a founder that's an ex-Stripe engineer, and with a co-founder that was a VC operator. We like to see like a legal and financial structure that's clean. So, something that's incorporated in Delaware or Nevada would be excellent. Clear milestones and risks. So what is a milestone? So basically a milestone is a goal with a clear time frame. An example would be we want to hit 1,000 paying users in 12 months. A company with strong upside with realistic planning. So a 1 billion market, and you want to have 10% of that market. That's realistic. But also it's big enough to attract investors of this type of asset class. And lastly, transparency under pressure. So you should share any bad news upfront and right away. Investors prefer that. We have all had things that have gone wrong in our lives. We've also lost money and made money, but it's also best to say like, I have this issue. I want to say it up front. Get it all out of the open. It's best to have that because otherwise it ends up being a red flag later on. So how do you stand out? The best way to do that is to be organized. And I don't know if this is repetitive from the previous, webinars, but I'm going to explain what a data room is. So a data room basically is a online depository of information. So the best example I would give is, every year I file taxes. A couple of years ago, I got a mortgage. So I was asked by someone else to give them a whole bunch of information from different sources. So for my CPA, it's like a 1099, W-2s, mortgage interest, et cetera, et cetera. So instead of having just pieces of paper on a desk and then dropping it off at the person's office and then them charging by the hour, you put it all in online, electronically into folders, logically organized. So you can use something free or something, that's cheap, like Dropbox, Google. Every day there are more AI tools that are being rolled out. So I'm not going to necessarily recommend anything, but you can kind of ask around other founders or people who work at Startup NV, and they can give you a good idea. I personally use Dropbox. It's excellent. You can just share a file. It's secure. It's safe. But it needs to be organized and logical. And what I mean by logical is if you're dealing with a lot of investors, there's a certain order that they do the due diligence. Usually it's first they ask you about the company, and then they may ask you about technology, and then they may have another meeting, and then they may actually get into the nitty gritty with the numbers and et cetera, et cetera. So your data room should be organized that way. It should be the first section should be, your corporate information, and then the next one should be any sort of technology and patents, and then you have your financial forecasts. Makes it very easy to talk to hundreds of investors, and basically to send them a data link that's safe and secure. So now we get into like the nitty gritty, helping you're going to see what's called a due diligence questionnaire in the future. This is how AngelNV does our diligence. And this covers, all types of businesses. So some things may not apply to you. This may also be slightly repetitive from your previous session, but I just wanted to go over everything. And if there's any, issues, just let me know, just ask any questions. So the first thing we'll ask basically is, what is the strength of your team and the board? So an example of that would be, the founder is a serial entrepreneur with 2 exits. Then we would ask something like, what's the prior startup and exit experience? So, what did you do in the past? Have you worked in this type of company, and have you been successful? So an example of that would be, a CTO that built a team at Google. Have you ever raised money before? Fundraising experience. So the CEO raised 5 million a seed round before. That would be an example of exit experience. How does the team work together, and how do they make decisions? So, for instance, investors like to look at a team that's been together for a while, at least known each other for a while, either through school or work together, et cetera. So, an example might be a team that worked together for 3 years. What's your option pool and what's the allocation? Have you created one yet, or do you plan to create one? So an example would be an option pool 15%, 10% been unallocated, meaning that we've taken 15% of our shares and created an option pool for future compensation of employees. But 10% of that has not been given out yet. So we have that amount of money or shares to give to new hires. What does your board look like? And do you have advisors? Usually in a company, in a startup, you want to have a board that's an odd number. 3 is the smallest. You can do 5 or 7 as you get bigger. And the reason for that is that if you have any sort of votes that are very, very difficult, you need to have at least a tie or an independent person if they're 2 strong opinions. So in this case, there's 2 founders and an advisor. So it's a 3-person board. And lastly, any sort of insurance policies, depends on the type of company you had, but in this one, an example is like 2 million for key man insurance. What key man insurance is basically, if a CEO or somebody in the C-suite dies, then you have an insurance policy that covers that person, because they're so instrumental to the company that you would need to start another, executive search to find that, and that's actually expensive. And also losing a key person cannot hurt the valuation of a company.
Miguel, can I interrupt for a second?
Sure.
How do you want us to do questions? Do you want me to watch the chat and interrupt you if there are questions?
I guess that's easiest, because that way I may be answered later, but I think it's, I want to whatever is best for people. So if there's a question that pop up, we'll be more than happy to answer it now.
Okay, so I didn't see a question, but
Okay.
something that I noticed that a lot of founders are completely unaware of and totally surprised about is the option pool. And that before they get a certain round of investment, that they're going to have to create an option pool. Can you talk about that a little bit more?
Sure. So I actually have an example. If you want, I can kind of go to that example. and kind of show it. But basically, as Maggie alluded to, an option pool, the reason that an investor wants to have an option pool is that those shares are taken out of the pie. So for instance, in the example, which I'll show later, let's say you start off with 100 shares and, 80 of the shares are owned by the founder and 20% are owned by an investor. And then you go out and you raise more money. Then you're going to want to hire people. And before you do that, you don't have a lot of cash. So you're going to actually want to give them equity. So when you do that, the amount of shares that the founder and the investors have will go down. And that's called dilution. So because you're taking 10% off the top, then the pie, instead of being 100, now is 90. So each person then will have a smaller amount of the pie, right? Instead of having 80%, they may have, let's say, like 70%. But now the pie is bigger, is worth bigger because you have brought more money into the company. And if a company was worth 4 million before and you brought in 1 million and now it's worth 5 million. So if that's not done prior to the funding, then the dilution gets more for investors. And we would prefer to see that upfront, and also to make sure that you have that in your business plan because you are going to want to hire people and compensate them highly because you want to grow a company quite quickly. So I hope that answers it briefly. I do have an example later, but is that anything else you want me to go in depth on that, or is that good enough for now?
I think that's a good overview, and I'm glad that you have an example. But
Yes.
Jean is also asking whether companies that are in the seed funding round need to have key man insurance before getting an investment, or is that something that they can do after?
That's an interesting question. I put it as an example, but I would imagine it would be part of your costs. If you're very, very small, and depending on the type of investor you're going after, there's probably something they would like to go see. I don't know off the top of my head if Startup NV requires it. I think we like
No, we don't.
to see it, but the reason to have insurance is just like any other one. If you buy a house with cash, then you don't need to have, insurance, right? Because you're basically taking the risk yourself. You're self-insuring. If you buy a house with a mortgage, then the mortgage company is saying, well, to protect our investment, even if it's highly unlikely that there's a fire or flood or whatever, we want you to have insurance because we lend you lots of money. So I think it depends on the type of investors you go after. Some angel groups may be okay with it, depending upon the type of company and the size of investment. But once you get into the more institutional type of investors, let's say like a venture capital or whatever, and they expect the company to get really large, and there's a large check they're writing, several million, they probably would want to see that either before or at the time of funding. I think
But
we good with that. Okay.
yeah, and that's all the questions we have right now. So
Okay, perfect, perfect. So now, then you're going to go on to the section of the due diligence questionnaire where it talks about corporate structure. So for instance, I'll ask you what's the legal structure of your company, and C corps are preferred. Where the C corp is incorporated, either Delaware or Nevada. Delaware is the default. That's where most corporate law is written. Nevada is obviously where we live, and it's actually up and coming and making a great competitor for Delaware. So, I think there's pros and cons for a jurisdiction. That's something that when you start up your company, you may want to talk to someone, either an attorney or CPA, and saying, is there any advantages of one jurisdiction or the other? But most companies you'll see at this stage are mostly Delaware. Who is your legal counsel negotiator? So an example would be, who's your attorney, right? There's going to be a name. This is a firm or a name, etc. Who's the negotiator? That's who is the person that the investors will be talking to discuss deal terms. Who's the main person that is the contact person? In this particular case, in this example, it's the CEO. The CEO is the person who's going to be talking to the VC firm or the angel firm, and with the back and forth on talking about a round. And do you have tax compliance? Have you filed taxes? If so, what kind of taxes do you file? In this example, something like we filed federal and state taxes filed. Our CPA did that. You put them in a data room for review. Then we get into, your growth forecast and projections, what are your top 3, 5 milestones? So again, a milestone again is a goal that's specific and also that has a certain time frame. So in this particular case, an example is, a minimal viable product, which is basically kind of like, your cheapest prototype to kind of get out into the market to kind of test, your customers. And we want to launch that in 6 months. That's our milestone. So you give us money today, in 6 months, we're going to have this product that we're going to go out and see how well it does. Resources needed, for intellectual property or cash or people. So an example would be like, we're 500,000 for of the money that we're raising is for development and marketing. Any sort of risk and mitigation plans. And this is where, for your business, when you do industry due diligence for yourself and analysis, you're saying, okay, what are the risks do I see to, scaling this business and what are my competitors, what do they deal with? So an example would be, customer adoption. Basically just getting customers and getting them to, stick with the product. How would you mitigate that, or how are we going to approach to mitigate that? You would get, letters of interest, so you would go out and you would get, 5 or 6 large, customers, and you can, have them sign something with you that says, that we're going to use this product for a certain period of time, or, we're planning to buy, the product because we like it. Now we get into, actual like numbers. So this part of the due diligence sheet, we're going to ask about, your projections and et cetera. So the first one would be the revenue model and assumptions. So there are about, I would say, 10 to 12 different revenue models. New ones are being created all the time in the world. So, that's depending upon what type of business you have. Some of them are recurring, some of them are more transactional, like one time. So in this particular case, this one is a submodel, so basically you're selling a product that a user pays $100 a month, and that's per person. So then, that makes it fairly easy for as an investor to say, well, depending upon how many customers you have and how many months in the year, I multiply that by $100, that will get me to how much, you're selling and all your revenue. Then you need to look at your costs and then how much you're going to use your cash. So in this particular case, is like, what are your expenses? How much are you spending every month? And that should be, a summary, but also detail as well too. So in this particular case, your burn, which is your kind of like your spending rate, is $80,000 a month, which equates to about $960K a year. So you have your revenue first, and then you have, okay, how much are we spending? Cash conversion, which is like working capital, that's something like, basically how are you selling your product? In this particular case, this is something like, close to retail, like 30 days, customer terms. You're selling to someone. Every industry has their own different ones. If you're selling software or if you're selling a plane or something, that might be different terms, et cetera. But this is something that you would put in here and kind of to show to the investors. Future product costs. So if usually in a business, the more you sell, the better pricing you can get from your suppliers. So in this particular example, you're saying, well, I talked to a supplier. In this case, is AWS, which is Amazon, and my cost will drop 20% if I can get to 10,000 users using their cloud services. So you have that, and you're then milestones to get to 10,000 users. So your cost drops. If your cost drops, your margins are, your revenue is the same and the margins get bigger. So, they always say like, with scale, you produce more money, and that's because your costs go down. So that's something that, in your industry, you should know about and disclose to us. And what is your backup plan if assumptions fail? This is where you do a little bit of, thinking, saying, okay, I have this plan, I have this revenue model, I have this forecast, but what happens if something goes wrong? What would I do? What's my backup plan, or how would I pivot? This particular case, an example, instead of selling to, consumers, then you may say, okay, well, instead of doing consumers on a submodel, we're going to pivot to do contracts with enterprises. So we're going to sell to big businesses, and have a contract for 1 year instead of sending on a monthly basis to just customers that have to come back every single month. The next few questions are, more about runway and debt, et cetera. So the cash runway for the fundraising period. So, what is the runway? Basically, it's like how much money do you have by months? So if you spend $10,000 a month and you have $80,000 in the bank, then you have 8 months of runway. So that's something that is a simple calculation that you can kind of disclose. Do you have any gap audits or, a prepped financials? So GAAP is a generally accepted accounting principles. It's basically the standard in the United States. I think there's an international version one. If your CPA or if your CFO does your finances under that, then you would disclose that and saying it was audited by this outside firm. If it's not, then in this example, you would say not GAAP audited but prepared by an outside CPA. So there's a professional doing it. It's just that we need to adhere to GAAP, and then you would explain, like what assumptions you're making that don't make it GAAP. So do you have any deferred salaries or commitments? Here, as an investor, we're looking for any sort of, future liabilities that would need to be taken care of, first when the funding comes in. So in this case, the founders are taking deferred salaries of $50K. So that, they eventually would like to get paid, and that's something that probably would need to be taken off the top. Do you have any debt? So, we sold a $100,000 convertible note at 6% interest. You would list that or any other type of debt that you might have sold. What is the current salaries of the management team or the employees? Let's say it's $80,000 now, but we expect to raise it to 120 after funding, to bring it to market levels. Everyone is taking a pay cut because they want this startup to kind of make it off the ground, and and cash is scarce. But once we get a little more funding, we'll have to live and we're going to work twice as hard with a little bit of a raise. Do you own anything or you lease anything? So an example would be we rent some office space here in Las Vegas for a few $1,000s a month. And financially, do you have any sort of internal controls? Your CFO or someone like that would be handling that. In this case, the bank statements are reviewed monthly by the CFO. So stuff comes in, that person is checking, making sure that everything is okay. So that we can, if any financial questions, investors can ask that person, and making sure that that everything is being adhered to. We now get into your current financing and the future. So your current financing is what you're looking to raise right now and what for. So for instance, an example would be we're raising $1 million for a minimal viable product and to hire a sales force. That's what we want to do right now. In the future, we want to raise a $3 million Series A to scale revenue. So we expect this 1 million is to get us to our product, and then once we have that product and we have some traction, to us to really scale it up, we're going to need to raise some more money to basically, ramp up marketing, maybe ramp up R&D or something like that, but basically to scale revenue. So you have this planned out for the next couple of years. What also is the future fund usage here? Another example would be sales expansion or rolling out internationally. And lastly, dilution expectation. So this is something I mentioned before. What do you expect the dilution to be? Another way of saying this is, how much of the company do you expect to sell in the next round? Usually, rounds are usually 20% of the company. So, as a founder, you start off with 100% at day one, and then you do your first raise, and then you sell, let's say, 20% of the company, and now you own 80% of the company, but investors own 20. But your company should be worth hopefully significantly more, so that your initial investment has gone up. What is your exit plan? Why do investors want to know this? This is basically how do we expect to get our money back? So what is your exit strategy? As a founder, you would look at your industry, you would do some research and et cetera, and you would see how competitors are currently being liquidated. For instance, are they being acquired? Are they IPOing? Or are they merging? So in this particular example, in this industry, most companies are being acquired by a consolidator. So there's like one company in the industry that's really large, that's going in and buying and kind of eating up these other companies. But they're paying, top dollar for that. And so that's a strategy that we want to get to the size that, we get on their radar. Liquidity events in the sector. This is part of your research, so a competitor was acquired 2 years ago for 100 million. We expect that now would be, maybe 200 million based upon, where the public markets are or where other competitors are getting, offers or term sheets. And lastly, a projection of like what the investors would expect to make. So the way you do this and saying, well, I expect to, let's say, IPO in 5 years, and I expect to be at a certain valuation at that level. So let's say, for instance, you're worth $100 now, and we expect to be worth $800 in 5 years. So if an investor came in at year one and they IPO'd at year five, then they would make eight times their money. That's something that you would first do the calculation at the end, and then compare it to where your original value is, and that's how you would come up with what the expected return would be. The amount of years is something that you should show, a couple different scenarios. You might want to show a pretty quick exit, like 3 to 5, something a little bit more on average, which is something like 5 to 7 years, or something a little longer, but the company grows bigger, so maybe like a 10 years plus. There are companies like SpaceX that are still private that continue to grow. And there's other companies, in the AI universe, they may be acquired quite quickly by, like a hyperscaler, et cetera. So it depends on the industry that you're in. There's some documents that they'll ask. They should be in the data room. You can kind of put them in various sections or kind of label them. But there's basically, like the articles of incorporations, the bylaw, the board minutes, if you have any, the cap table. That can be basically like a spreadsheet, or there's some online resources that you can kind of help fill them out. And that's basically, who owns the company currently and who will own the company in the future. So an example would be the current capitalization table. The founder, you guys that started this company own 70%, investors own 20%, and then the option pool owns 10%. Just 3 line items, that very, very simple. Depending upon how many funding rounds you have, it can get a little bit more complicated, but it can be as simple as that. Do you have any financial statements? You would put that in there saying, oh, the past financial statements, 2022, 2023, they're in the file. Any sort of exit comparables. 3 companies were sold in the last 2 years, maybe like a press release or a news article, or something from the internet that, you did part of your research, you could share with us to help our due diligence a little easier. And then, insurance again. Do you have any directors and officer insurance, any liability policy included, anything like that? You put in there so we can take a look to make sure that the investment that we're giving money to, that that any risk that we would see that's unforeseen is kind of covered by that. These are things that are low probability, but they do happen. In here also too, you have a break-even analysis, which I'll go into a little deeper in a few minutes. So I wanted to take a stop here and talk about online resources. So, there are many different ways to create a financial forecast or a cap table. So I didn't have anything that I want to recommend because I know Startup NV has some resources and new things are being created every day. But you can do a search. If you do something, I did it prior to this presentation of like 5-year forecast, for a startup. And you can come up with a template that's for free and you can download it and bring it in. We may have one that we could share as well. And they could actually have the template for a specific industry. So something maybe a SaaS, software company industry, or an AI one, or something that's very hardware focused, a lot of plants and equipment. You might have to worry about depreciation and things like that. You would have that in there. That would help you create like a balance sheet, an income statement, and a cash flow. All that would be in one spreadsheet. The reason I say that is that when you create your financial forecast, it should be, in my opinion, should be the last thing you do. And the reason I say that is you put together your strategy, right? Your customer acquisition strategy, your marketing strategy, go to market, all those things. And you kind of put together like this roadmap with all the research you had. And you're saying, okay, well, we're going to go after this market, and we think we can get as many customers, and we think that this is how much it's going to cost and how much it's going to make. And then once you've done all that and you kind of iron out, say, any obstacles, then you start putting it into numbers. And you say, okay, well, this is what we wrote down in words. Let's put it into, into spreadsheet. And then you can kind of tweak it. And what I say by that is that you have this base case and saying, okay, everything goes well. This is what's going to happen over the next 5 years. But then you may want to change a variable, which is called sensitivity analysis, right? You may say, well, what happens if, as one of our costs, goes up. So what happens if, just one particular supplier goes up? You change the spreadsheet and it changes all the models. Does it still make sense? Did you still making money? You still have enough margin? Does your original word strategy, is that's still a good roadmap? And then you have what's called scenario analysis, which is, you change a lot of things at once. So for instance, if you have a disruption in your supply chain, and then, you have to basically go after a different supplier in different countries, and the delays in that, how would that affect the entire business? And you would change multiple variables at one. That's all done on a spreadsheet, and it can be dynamic. And it probably take you a couple of days to build a nice forecast. And the reason I say that is because you want to think out different scenarios. When you do that, though, you want to make sure that your revenue is qualifies for what we call like what a startup is versus a company in the startup phase. And the reason I say that is a company in startup phase is a company that will grow and will make money, but probably won't double every year. So that to me is like my back of the envelope kind of metric for a hyper growth or a growth company. And the reason I say that is that when you get to the institutional rounds, for like a VC or et cetera, when we exit or when you look at companies, you probably want to be close to a billion market cap. And there's many ways to get to a billion market cap, which is what we call a unicorn now. But companies are getting bigger every day. If you look at the public markets, there are many companies that now are worth in the trillions, and they will get bigger in the future. But if your company doubles every year for 5 years, if you start at zero, you'd be very close and over 100 million in 5 years. If you have what's something called a 10 multiple, versus your revenue, which is your sales, your top line, then if you have 100 million times 10 is a billion. That's how you would get there. So you can play with those numbers with the revenue multiple or the amount of revenue you make, but you should be a very large evaluation in 5 years to get the kind of numbers or returns that investors are looking for. So that's why I was saying you want to start at the end number, like when you're going to sell the company or either be acquired or IPO, and work back to your original numbers. And you can do that in the spreadsheet by starting at the end and then working backwards. The easiest thing is actually your today evaluation. The hardest thing is actually figuring out what is worth in the future. Now, a caveat to all this is that no matter what financial forecast you do, the numbers are going to definitely be 100% wrong. Every investor knows that. What we expect, hopefully, is that whatever you forecast, everything is a lot better and more optimistic than you can ever possibly imagine. That's a more kind of a quantum event. But it is possible that things could take longer or slower or things could be harder than you expect. And then the scenario sensitivity analysis, you would do that yourself. So when investors come in with questions and ask, what happens if this happens or what happens if that happens, you would have a good answer to be able to at least try to, predict what you would do in the future. So that was all I wanted to say, that, that you don't need to reinvent the wheel when you do this. There are resources online. A lot of them are free. A lot of them are from Startup NV. So if you need any help, I think they can kind of come in and, later in the series, I think there is some office hours for that. So here's an example of a calculation that you would want to do. So break even, what we talked about before. So in a business, you have two types of costs. You have fixed costs and variable costs. So a fixed cost is basically a cost that you have to pay no matter what, no matter how many units you sell. So if you sell 1 unit or if you sell 1 million units, in this particular business, you have to, you need to spend $600,000 a year to produce this widget. a variable cost, that actually, it can change. It can go up and down depending upon factors. Some of it could be the more you produce, it could go down, or it could be inflation or et cetera. But those costs, change over time. So in this case, you have 600,000 a year, which is what is your fixed cost. And your widget or your product is, the average sale per unit is $50, and your variable cost is $20. So you just subtract 50 minus 20, and that gives you what's called the contribution margin, which you could think of it as like a net profit of $30. So to get to your break even, the amount of units you need to sell to get to zero, and the next step would be profitability. Divide 600,000 by 30, and you get 20,000 units. And then the importance of that is that in a startup, when you get into profitability, you're into the next stage of evolution and in a completely different category than startups that are non-profitable. The only caveat to that is startups could stay non-profitable for very long if they're reinvesting in their company, if you have a lot of R&D or things like that. But that is something that investors like to know, like when in the future will you be making $1? So I do have a chart that kind of shows it a little bit. Hopefully this is clear. So the orange line is your fixed cost. As you can see, it's completely flat for the entire time, entire amount. The blue line is your total cost. That's fixed and variable, right? So you can see it goes up as when you sell more units. And the green is your revenue. That's your sales. So as these two intersect at 20,000 units. So that's basically the visual view of what the calculation I just did before. Then we want to talk about runway calculation. So this is something that the due diligence will ask you to do. And we talked about it a couple of times before, but here's a nice simple example. So you have $500,000 in the bank, right? And you spend $50,000 a month to run your business. So you divide 500,000 by 50, that gives you 10 months. So you have 10 months of cash. The I guess suggestion would be that you should raise funds 3 to 6 months before your cash runs out. So what does that mean? So if this is January and you run out of money in October, then you should start with money, somewhere in the spring or early summer. So maybe somewhere between April and June. Timelines in the current environment to raise funds have been longer than they have in the past. So I'll take this 3 to 6 months as a rule of thumb. But when you do raise money, you would also like to have not to raise money that often too. So you probably would want to raise money for maybe a year to 18 months, or to get you to the next milestone, which would be sometime around that period, between 1 or 2 years. And this is a graph of basically just what runway looks like. You don't want to see this, but this is just the natural decay of your cash burn. You start off with $500,000 over 10 months, and then it goes to zero. And I think this is the last illustration that I have, which is basic option pool and dilution. So going back, option pool, this is basically the amount of shares, that you're holding to kind of pay future hires. These are people that your engineers, your C-suite, your head of sales, anything like that. It's very, it's tough to pay them with cash. You can't pay them high salaries because, you're burning a lot of cash as a startup, and you don't want to constantly be raising. So you pay them with equity. The upside is a lot more. So in this particular case, this startup, the pre-money valuation was $4 million, right? And then you raised $1 million. So then the next term will be called the post-money valuation, which is called $5 million. So 4 million plus 1 million equals 5 million. So your company now worth is $5 million. But you created an option pool, you increased it by 10%. So the option pool was, $100, and then now, you take 10% off the top. And so 90% of the shares are left to give to the founders and to the investors. So what does that mean? So the way that you would calculate the dilution is a fairly simple formula. You just take the 90%, which is the 10% off the top, and you multiply 0.8 and 0.2 by 90%. So if you multiply 90 by 0.8, you get 72%. If you multiply 95.2, you get 18%. So in the next slide, you'll see what the post-money valuation looks like. So the founders now own 72, they own 80, and now they own 72%. The investors own 20, and now they own 18%. The option pool owns 10, but this whole pie, instead of being worth 4 million, is worth 5 million. And this is my last slide. Hopefully the timing was good. My closing message is due diligence is your opportunity to show how prepared you are, how disciplined you are going to be with the finances that we give you, and how trustworthy you are. Founders who answer the questions clearly, confidently, win investors' trust and funding. So, for instance, a founder who pitches, we include your full financial model and a clear path to exit, would definitely get the attention and get to the head of the line of investors versus someone else who did not. So that is just my my advice. So that's all I had. More than happy to answer any questions, go over anything else that was unclear. I hope that wasn't too quick, and I hope it was thorough.
Thanks, Miguel. What occurs to me is that I love your message of be honest and be upfront. But Josh is on the call too. And I think that we could, and Garrett too, we could talk about some of the issues that have killed deals, especially in AngelNV, where the due diligence didn't go that well. So in some cases, like this past one, we had issues with IP, intellectual property, and patents. So I wonder if you guys would talk about that. And then also, Josh has firsthand experience with his team, kind of like starting off with terms at one level and then changing. So Josh, are you in a position where you can speak? Yes. Okay, good.
Yeah, I mean, really, it all goes down to the concept of being upfront and honest and not trying to hide the ball. The last thing you want in diligence is this idea that we're trying to get information out of you and we have to go digging for it. That's not the goal of diligence, at least ideally in an ideal world. Diligence should be a collaborative effort. And to Miguel's point, when you come in, the better prepared you come in, it's not necessarily that it's less work for our investors or the investor group, but really when companies are so early, we really have to attach on to as much signal as we can as possible. And one of the strongest signals you can provide as a founder is being well organized and prepared, and also being forthcoming, not only about, and one thing is that I think the founders get maybe a little caught up in is, listen, at the very early stages, your company will have warts. Your baby will have warts, and that's okay. The goal is not to obfuscate or kind of hide that, but just kind of be very, very honest about those things, because it's much worse for us to feel like we have to kind of pry that sort of information from you. But to the example that Maggie used, yes, once you start getting into term sheets and offering up terms, the deal can go south very, very quickly if you are verbalizing certain terms or valuations, and those get changed once the documentation comes out. That's a way to really throw a wrench into things very, very early on, or once you get into that stage. So just be mindful of that and understand that it's a collaborative sort of, or ideally should be a collaborative sort of process.
Yes, you're both trying to get to yes, right? The investors are trying to get to yes, and the founders trying to get to yes. So it is a collaborative process. Josh, do you remember, because you were part of AngelNV 1, right?
AngelNV 2 was my first.
Oh, okay. So in the first one, the investors, so the way it works with AngelNV, like we bring a bunch of people together and we are voting on who's going to advance, and then we vote on who the finalists are going to be. And we try to get to 6. And when Josh is around, it's usually 7. And then the angels break into teams to do due diligence on the various companies. And sometimes it's based on what they're interested in, or it's that they don't know anything about this business, but it's kind of captivated their imagination. And early on, we would go, if there was a physical presence, we would go tour facilities. Josh even came up in his first year, AngelNV 2, to visit one of the finalists who was outside of Reno. But in this first one, we were on a tour with the manufacturing of this tank, and they had a technology to measure tanks so that you didn't have to, go by and stick a pole in to see how much liquid was in this tank. You could read it electronically. And so it was while on the tour and just talking with the people who were there that we discovered, just by chance, that they had loans that they hadn't disclosed in their due diligence. So they had like $300,000 worth of loans, and then they didn't have a good answer for why they hadn't disclosed it. And so that was just a total breach of faith. And that was the end of due diligence for that team.
Yeah, miscategorizing revenue or hiding loans, I've seen that multiple times. You don't want to do it.
Yeah. Let's see what else. We now have, who's part of our group, a fella who prosecutes patents, and he's not a patent attorney, but he will prosecute patents that are being infringed by large companies. And so having Dimitri on the team now puts a whole new spin around companies that are basing their business on their patents, because he can quickly discern whether it's a valid patent, whether there's any merit behind it. There's a question in chat about how many finalists and how many get funded. So 6 to 7 finalists. And again, this process is different from any of our other affiliated funds, which all have investment committees. This is an egalitarian process. So everybody who buys a $5,000 unit gets 1 vote. You can buy 4 units or more, but you're only going to get 4 votes. And so the companies move through the process based on those votes. And then when we get to the end, we'll have a good idea of how much money we've raised and how much money we have to invest and who the front runners are in this process. And so at least one will get a $200,000 investment, but there could be others who get investment as well, depending on how much we've raised. And it's something that the angels decide among themselves. It's usually the Tuesday before we have our final event. And our final event this year is April 11th.
I just wanted to add, when the beauty of this program, and to Maggie said, I was involved with it as an investor for 2 years, but I've been around since the beginning, but I wasn't allowed to invest in it because of where I worked. The people who win or people who pitch get exposure. The people who win can as getting the funds, or actually a lead investor, or to just winning. They go on to raise larger rounds within the same period of time. So they kind of use the money that they get from here and the matching from the state, and then also they can talk to other investors, and they raise much larger rounds, close into the 7 digits, which makes it a wonderful program. So it's kind of like you do the work once, and you can take that finished product and show it to a bunch of investors and raise as much as you need, because we probably are the hardest. As most investors say, for an angel group, quote unquote, we underwrite like a venture capital firm. So if you can go through that due diligence questionnaire, you're basically set for the future institutional rounds as well too.
They do get tougher though. You get to an A round and it's just like, yeah, they're going to know what disease you had 2 years ago. Yeah, somebody asked in the chat, he or she suggested that they were a Nevada LLC right now. Should I start the Nevada C Corp process before applying? And my answer is, if you're serious about seeking venture investment, yes. If you're thinking that you need to do that just for this particular investment possibility, no. So if you are going to, you're bound and determined to have outside investors. Angels will not require you to be a C corporation, but almost every other group will. And depending on how long you've been an LLC, it can be time consuming to detangle it.
I would say that with recent events in the ecosystem, there'd be more onus on people becoming a C Corp rather than an LLC. That's really starting to get dinged in the early stages.
Yeah. I think it was 2 AngelNVs ago. The angels voted for a secondary company to get investment. They were an LLC, and they were a group of professional people. And so detangling that particular LLC took 9 or 10 months. It takes a very long time. And because of that, we've learned our lesson. And so if you get to the finals, or you're almost going to get to the finals and you're not a C corporation, you're probably going to be eliminated. But you should not base your decision on AngelNV. Having an LLC longer is harder, yes. Especially if you have partners, other people that are in your group, that is what generally makes it tough to detangle by the attorneys. Yes, you do have to start as an LLC, probably. Most companies will. You don't have to start that way. You could start as a C Corp. I just think it's more expensive. Okay, anybody else have questions or thoughts? Okay, I did post our due diligence questionnaire in the Disco platform, so you guys can all take a look at it. It is exactly what we use when we go through this process. We didn't invent it. We borrowed it with permission from the Tech Coast Angels, and Tech Coast Angels started as an angel group in Orange County, I believe. And then they've been sort of like eating up other angel groups. So they've gotten to be a very large group. So they are standardizing lots of things. Okay. Would you recommend converting the LLC or starting a brand new C Corp and merging LLC into it? Talk to an attorney. I have no idea. We do have the attorney. Oh, Garrett has his baby. The attorney that we had last week speaking, Craig Macy, they do a lot of setup for startups. And so he is somebody that we recommend. You don't have to use him. There are, I think, Caleb Green in town. No, he's an IP guy. Josh, what do you know about basic startup attorneys?
As far as resources here in town,
Yeah.
Craig's the one that I think of often.
Okay. Garrett, Miguel, do you have ideas?
So I think it's typically easier to convert, but it does depend on the state. So depending on where you're incorporated, it may be more or less complicated. I also found my first startup, we actually got everything set up as an S Corp because it made the costs and the compliance a lot easier and cheaper. But then when we went to go raise, it was an easy, because as an S Corp, it's passed through like an LLC. So you have to have bylaws and stuff, which ChatGPT can make for you now pretty quickly. But then when you go to raise, you just don't file as an S Corp anymore. So but in Nevada, I think it'll cost you like 200 extra bucks a year to do that. As opposed to an LLC is like 300, I think, instead of 500 a year.
I think it's 375, and then your first year is about 475.
Yeah, yeah.
Yeah, the difference in California was huge, though. To be a C Corp in California was 800. Well, this is years ago too. $800 versus an LLC was less.
Oh man.
Yes, gotta love Nevada.
It's $125 to get started in Louisiana, and then it's $35 a year to keep it open. But that doesn't really help you in Nevada.
No, and I don't really want to live in Louisiana.
New Orleans is great. But no, I agree.
Okay. All right. Both entities would be Nevada corporations. Oh, this was the fellow who asked about the LLC or creating a new C and rolling the LLC into it. I really don't have any idea. Consult an attorney. All right. So next week we're going to have Garrett, who's with the baby right now, and he'll be presenting on sales and marketing. That's another area for due diligence. And after that, we'll have Danielle, and she's going to talk about tech products and tech roadmap and the DD that you have to do around those things. And it does help to have technical people involved in performing the due diligence. Otherwise, we're easily snowed as stupid people who are not technical. Speaking for myself. Okay,
That'll be
you
fun.
can. Yeah, who was talking, Garrett?
Oh, I said it's going to be fun.
Yes, it'll be fun. So on Friday, you'll get a message from Disco that the video has been posted, and I've received Miguel's deck, so we're going to post that as well, if we have permission, Miguel.
Yes, yes.
Okay.
I
right.
sent it to you for that. I mean, it's if anyone had any questions, they can always reach out to me as well too, if they wanted some more explanation. But yeah, it's to be shared and to be to be used again or whatever.
Okay. Thanks, everybody. We'll see you again next Tuesday.